Hey guys, welcome back to another episode of Sky's the Limit podcast. Thank you all for joining. Today we have Justin Brennan, founder of the Brennan Pohle Group. Justin focused on property acquisition, underwriting, construction, and development. Actually, Justin grew up learning from his father, Jim Brennan, who developed over 8,000 multifamily and single-family subdivisions throughout California, Nevada, Arizona, and Idaho. Right now, their group currently owns 1,200 units across the state, or across the country, I should say, in multiple states. With that, Justin, welcome. Thank you for joining the show.
What's up, Michael? Appreciate you having me on, man.
Yeah. So obviously, no one gets to 1,200 units right off the bat. So you likely started with one, maybe single family condo or one multi, and now you are where you are here. But tell me how you got there.
Yeah, it started really. I grew up a little bit in a real estate family, so some people are around it a bit when they're young. Some people not at all, right? So whether you're completely a newbie, novice, doesn't really matter. But I was fortunate enough to watch my grandmother. She started it off, and God bless her soul, at 91 years old, she was still driving around in her little S10 Chevy truck, collecting rent, and all her little apartment units that she owned, all on her own, right? So she did the whole my own money thing and never got into the OPM game of, hey, I'm going to use my money with other people's money, because she never understood it. She grew up in the Great Depression, kind of, hoard everything, reuse Ziploc bags, all
Yeah.
that basic stuff. As a grandmother, you can imagine, a little Italian woman, but learned a bit from her, and she passed that along to my dad. And then you're mentioning him because he was really that transitional character in our family. We didn't grow up rich or wealthy, but he took us there. We started a little 3-bedroom, 2-bath home in San Diego, and then he started after he came back from Vietnam, got into real estate, started with sales, hated it, and then said, I'm going to start building some things. So he started with a little home here or there, and he got into a little larger subdivisions of maybe 5, 6, 10 homes. And then said, heck, let's go build a condo complex with a bunch of them, essentially multifamily, but it's condos for sale. And then it went into big apartment complexes. But he would never hold them. He would always build them like 200-300 unit complexes. We're talking big stuff. But then he would sell them off to other firms and other people who would do the holding game. And he would make tons of money. That wasn't the problem. But then he would also get caught in market cycles. Right. And then our family income would mimic a real estate cycle, like almost to a T.
Right.
And so it taught me a lot of things watching that. He weathered through it, but made it through multiple cycles. And then here comes the financial crisis of 2008. And at that time, walking into it, he was, you'd think not over leveraged, but it became over leveraged very quickly.
Sure. Right.
And it all imploded. And he went through, I watched him go through about a $60 million bankruptcy, and it was crazy. Yeah, it was wild watching that happen. So I've seen it all. I've seen poor, or not poor, I guess I would see lower middle class, right, is where we started, to middle class, to then riches, to then back to middle class again. I've seen it all, bottom to top and top to bottom. But it teaches you a lot. And what it taught me was cash flow is very, very important. Not being over leveraged is very, very important. And this is why apartments, for me, the cash flow game of apartments is more important than dealing with, high highs and low lows, right? Booms and busts. And it's just the way I've decided to grow what I've done post my dad. And, it started in 2010, right? Kind of as we're coming latter part of the financial crisis. I just knew we had to buy property, but I didn't have any money. I was getting my ass handed to me at that time because I was in real estate. And, but I had a skill set, right? I had the ability to go find deals. And this is kind of speaking to anybody that may be listening to this. If you're like, listen, I don't have a lot of money either. Okay, cool. Well, then you need to have a skill set. You need to have the ability to find deals, analyze them, put them together, run the company, manage, right? These are very, very valuable skill sets that someone with money would love to have, but maybe they don't have them. And now you can bring them to the table. So you're extremely valuable to them because they want to do what you want to do. They just can't, but they have a pocketbook a little bit, right? A little bit of money. And maybe they can sign on the loan and you can't. So you guys partner. And that is literally how our company started, the Brennan Pohle Capital Group. And that was in 2010.
Okay.
And we bought a $100,000 condo in Murrieta, California, right? Nothing sexy. I think it cash flowed at $500 a month, which was about 27%. I mean, cash on cash, right? It was really good for a little condo. It wasn't a lot of money, but it was a start. And then we got into duplexes and triplexes and quads and stuff like that, but all still single family, right? Still single family game, because we didn't understand the game of OPM, other people's money. I didn't understand the game of money, period. We thought I had to do it all with my own money, and I was scared to raise money. I was scared to go out of state. I was scared to go after bigger deals because of the whole fear of everything you can possibly think of. I was in. But I knew we wanted to go bigger. I knew we didn't just want 20 units, and here and there. Like, that was great. It was fine, but it wasn't getting us to where we wanted to go. We were still playing small ball. And we wanted to go larger, but all of our money was stuck in these deals. What do we do? Right? You can either sell them, sure, or you have a capital gains event, taxes, all that stuff. Do you refinance them and pull the money out and do other things? That's a good option. But then how do you do it? Right? And so I had to learn syndication. I had to learn OPM, other people's money, and I had to get comfortable with it. And I had to punch through a bunch of my fears that I had and go for it, man. I had to go for it. And I finally did. In 2018, we had about 20 units at that time, about $3 million in assets, which was okay. But, Chris and I, we wanted to go for it. And so I said, Chris, I'm going to learn this game of syndication and OPM. I flew across the country, spent $1,000 to go to a conference, sat in a room with 3,000 people, looked at all of them on stage, the people in the rooms. And, you could have imposter syndrome. That's definitely something that crossed my mind. But then I sat there going, man, like, if these people can do it,
Hells, I can too.
This guy can do it, right?
Yeah.
And I met a couple people there. One of them lived in Kansas City, Missouri, Midwest, because I knew we had to go out of state because we were in California at that time. Too expensive, right? Our dollar couldn't go far. We needed to go buy apartment complexes where we're paying $50,000 to $150,000 per unit, so our dollar could go farther and we could scale. And that's where we went, Kansas City, Missouri. Our first deal was a 27-unit apartment complex. Brought in about $900,000 total. Okay. We, meaning Chris and I, brought in 70 grand. Okay. $70,000 of that 900. We raised the rest. Right. And we got an acquisition fee as well of about $45,000 for putting the deal together. So we were out of pocket less than 30 grand, physically out of pocket, and had control of a $2.2 million 27-unit apartment complex. And by the way, getting the loan, we had to get a $1.7 million loan. I thought there was no way in hell. I mean, because I didn't understand how financing worked, because I came from the residential world thinking, I need to put 20% down, and then they're going to look at my financials, and I have to have this, and I have to have that, and up, down, left, right. And then you realize, no, this is commercial financing, much different. They look at the property, right? It's its own operating business. They could give two you-know-whats about you. You're secondary in the process, basically. So they'll make sure the property's financials, which that's what's going to happen. If the property produces the cash flow enough to pay that mortgage, they're going to almost throw the money out the front window of the bank and hit you in the forehead. Because they want to lend money. They just need to lend it on properties that make sense. So once I understood that that's how lending works in the commercial world, meaning the minute you go to 5 units or more, you're stepping into commercial finance. And with that, they look at all of those buildings as their own business.
Right.
Simply put. And so if that business is producing the money to pay them, here's your money. So the loan is relatively easy. Now we had to go raise 800 and something thousand bucks, right? So this is what scares the crap out of most people. And it did me. I was hyperventilating because we had to close the thing in 60 days. And I'm sitting there going, oh my gosh, how am I going to do this legally, financially, all these things. And I learned on the fly. We learned the syndication game, how to put it together legally, had our attorney do it. Here's the key to it. It is not that hard to raise money if your deal makes financial sense. And what I mean by financial sense is that thing needs to return double-digit annual returns to your investors, and they will likely bring the money in.
Right, 100%.
I mean, that's it. I mean, because most investors are getting, single digit to maybe 10% in stocks, bonds, mutual funds, 401ks, IRAs, other things they're in on an average. And so if they can move some of that money into a real estate asset now and earn cash flow with you, and then also get these massive tax write-offs against their income, I mean, it's silly. And that's why they do it. And so once the deal makes financial sense, raising the money is not as difficult as you would think. It's actually quite easy as long as you have a system. You have to have a system and a process, and you can raise it. But it starts with the deal. The deal's your lure, right? It's your bait. And if that deal makes good financial sense, and then you send it out to 25 people, because that's exactly what I did. I mean, I had a list of 25 people in a little Excel database. I emailed all of them, put the pitch deck in it that described the deal, sent it out on I think a Thursday. And by Monday, 11 people responded out of those 25. Out of those 11 people that responded in the 25, I set up 7 phone calls. They reviewed the information on the deal. They had between 25 to 100 grand, depending on the investor. And we raised that money in 2 weeks. And my jaw dropped. I was just like, it can't be this easy.
Right. Now, how much, obviously, if out of 100%, so you have 100% equity, how much equity are you giving out to investors, and how much are you and your partner keeping?
Yeah, so this was another thing I had to get over, because most people see that, you're giving up a majority of the equity or the ownership. I'm like, you're not seeing it right. This is what you don't understand about the game of money. This is what I had to learn, because we were stuck in the 100%. We had 100% of 20 units, $3 million. Sweet, right? Sounds good. But what we did is we realized, we can go get 30 or 40% of a much bigger pie, right? And still have 100% control, meaning decision-making, voting rights. Right. So think of this, just do the simple math. You can have 100% of 3 million, or you can have 40% of 200 million. Which one sounds better?
Right.
And that answers your question.
I think that's where I'm at now. I'm stuck in that because I we interview a lot of syndicators on the podcast, and my rub with it is that if you're a long-term investor, is that you always have to sell the asset at the end of the day to meet those kind of double-digit returns. But I've never really thought about it as, well, how long is it going to take me to get 100 units and retain 100% equity of it? Years. It don't come from money. It's going to take years.
Assuming you even are able to do it.
Exactly. Yeah. Versus now, like switching your mindset. Well, if you just have 30 or 40% of one deal that is 100 units,
yep.
You're not there yet. But are you refinancing? Are you selling these units? So that I get going back to my.
So let me give you a couple different scenarios, because this will help answer some of these questions for people listening. So our first deal was a 27 unit. We held that thing for 5 years and then sold it. Okay, so that was that option, and we made about $1 million, right? And investors made good returns, massive tax write-offs, awesome deal. Okay, second deal, bought that thing, stole the property, great deal. Year 3 came along, so this is how you play the game, right? We gave up 60% of the equity of the deal. We held 40%, right? Because it's usually between 40 to 30 to 40% you hold. Right, as the syndicator sponsor, you give away 70 to 60% of the equity. But keep in mind, you're only bringing in 10% of the money, and you're getting 30 to 40% of the deal. Plus, keep in mind, you have 100% decision making. So you control the daily, everything that happens with that property. So even though you don't have the ownership control, you have the decision making control, right?
Right.
And they're bringing in 90% of the money. Right, the investors are coming in with 90% of the money and getting 60 to 70% of the deal. But their returns are pretty good, 15, 16%, maybe 18% a year plus tax benefits. Your returns as a syndicator, 30, 40, 50% a year on your money.
Yeah, cash on cash, right? Yep.
Oh, yeah, it's stupid. It's stupid because you're coming in with limited capital. Right. So your returns are astronomical. So the second deal, we refinanced that thing year 3. Right, we bought the property for $1.5 million. We refinanced it at $3.6 million. Okay, paid out all the investors, paid them back.
That's key,
including myself. There. Okay,
yep.
Everybody's out. Now the investors are gone. So now I have 100% of 100% of 100% of 100%. Now, that does not always happen on the deals where you can actually pay them all off and all that stuff. Depends on the value, right, in the market.
Mm-hmm.
But you should be able to return at least 30 to 40% of the investor's equity at that refinance right around year 3-ish,
Right.
depending on interest rates and what's going on. But the whole name of the game is always to buy 3, sell 1. Buy 3, sell 1. Buy 3, sell 1.
Okay.
So that way you're always accumulating, but then you're having liquidation events. And the science to it all is anytime you sell any of your properties, no different than we're doing right now, coming up here in 45 days from now, is we're selling one of our 30 some odd unit properties, and we're closing January 6th of 2026.
Mm-hmm.
The reason why is because we're going to have pretty $2 million in capital gains event.
Right.
So I'm going to give ourselves and all of our investors a 12-month runway to go put that money, the taxable money, in not even a 1031 exchange. You don't need those anymore if you play the bonus depreciation game, because now we have 12 months to go find another deal, take that money, whatever our taxable event's going to be. And like in our case, it's going to be about 150 grand. So we're going to go stick $150,000 into another apartment complex, and we're going to bonus depreciate that thing in 2026 and wipe out our taxable event.
Have you already, right? Would you have already done a cost seg study on the one that you're currently selling?
Yes, that happened when in year 1. So keep in mind the way that the cost segregation is the report. That's the process,
right,
to produce the depreciation.
Yep.
So when you buy a multi-unit commercial asset, you're doing that immediately, right? Because you get the biggest write-off year 1 of ownership, right? You're accelerating this depreciation on the property, and you're giving that to the investors. So as long as you're doing, and yourself, by the way, everybody gets it. As long as you're doing one of those a year, you literally won't pay income tax for the rest of your life. I mean, I haven't paid income tax in 9 years.
Yeah.
I mean, for the first time ever, Michael, think of how stupid this is, silly. I haven't paid income tax in 9 years. And this year because I just filed 2024, they gave me a refund of $7,800. Like, I haven't paid taxes.
Not bad.
Also, the IRS just paid me.
Yeah.
Because of all this bonus depreciation stuff that works out. I mean, it's.
So I'm doing my first couple of cost segs now on a few properties, and my only, like, if you plan to hold on to them forever, that's fine. But how has recapture?
After year 5, it doesn't matter.
After year 5, it doesn't matter.
Correct. Okay. So that if you're selling it, years 2, 3, 4, sure, you're going to have some recapture, but all that bonus depreciation happens right over the first 5 years. So by year 5, that recapture is very minimal. Okay. But the value that you get from that bonus depreciation well exceeds recapturing that money back in.
Yeah. Okay. So it's still worth doing, essentially.
Oh yeah. Yeah. Now, obviously you don't want to do this whole bonus depreciation when you're going to sell it in 24 months. I mean, that doesn't make any sense, right? Because you're going to have a huge recapture if you try and pull that off.
Exactly. Yeah.
So yeah, as long as you're typically in that 4 to 5 year window, then you should be fine.
Okay. Yeah. And as far as underwriting all these deals, I think that's selfishly one of my struggles is, I can underwrite, a 2 to 20 unit deal, but when you start raising capital and having to, underwrite the return for these investors, and you have to factor in, okay, the return is X, Y, and Z, but it's going to be even more after we do a cost seg study. And what does that look like? Like, how are you underwriting your deals right now?
Yeah. So, we have, I have 2 deal analyzers, right? And for people that are just getting into this and learning it, I call it the 0 to 50 unit analyzer. Okay. It's much simpler. You're a newbie, you're just learning how everything connects, right? And seeing I call it the waterfall, in terms of, what goes to you, what goes to investors, and that simple process. So it's a 3-tab deal analyzer. I'll even send it over to you. And that helps us analyze the simpler, call it 5 to 50 unit apartment complexes.
Yep.
And then sure, when you get above 50 units, right, it gets a little more sophisticated, a little more variables, the nuance. Maybe you're bringing in more money, private equity deals, and all the other things that are complicated. So those deal analyzers are much more complex. But for anybody getting started that may be listening to this, a 0 to 50 analyzer, and there needs to be different ones, by the way. Anybody that's trying to send you, oh, this one's good for everything. I mean, it may be, but your head's going to blow off your shoulder when you look at it, because it's
exactly
going to be just so foreign. You won't even know where to start, what buttons to push. But having a simpler one to start is very good. That's what I start everybody on that's in our community, so they can get a grasp on how the numbers connect. Meaning, if I change the price here, or if I increase rents here, or if I drop the expenses a little bit over here, or if the interest rate changes a little bit here, or if I do this, the little things, what will that do to my overall returns? And it shows you right there.
Yeah, that'd be awesome. That's really interesting. So, what would you say your kind of aha moment was that pushed you into syndicating? Was it, a couple years in after owning, the 20 units, you're like, going to that conference, you're like, if these guys can do it, I can do it too. What was it at that moment? You're like, okay, this is for me.
Well, yeah. So a couple of reasons. And we all, at least I do this for a much bigger purpose, right? There's philanthropic reasons that I have visions for. Obviously, I have my family, and getting more passive income and spending more time and being able to travel, wake up in the morning, not have to go into an office, and have control over what I'm doing for the rest of my life is a very powerful purpose. And then giving back and helping others. But for me, the aha moment was realizing, so let me get this straight. I can bring in limited capital, maybe $30,000 to $50,000 out of pocket. Okay, $30,000 to $50,000 physically out of pocket, and control a multi-million-dollar apartment building. Get paid 5 to 8 different ways, right? Because when you go buy a single-family rental or a short-term rental or a flip or whatever, right? You're getting paid 1 to 2 ways. In a multifamily building, you're paid 5 to 8 ways.
Go through those real quick.
Yeah, so it starts with cash flow monthly.
Yeah.
You get your profits when you either refinance or sell it. That's pretty standard. All the tax write-offs that come through it through bonus depreciation.
Sure,
so that's the big three. Then we get into the fee structure. You get an acquisition fee. This is a very standard fee, 2 to 3% of the purchase price for you putting the deal together. And that comes out day one. So literally, if I have $50,000 going into the deal to close, and that's mine, and I'm getting $20,000, $30,000 within 7 days of closing it, right?
Yeah, not bad.
I mean,
and that's right on the HUD statement, right? It just comes right.
It's not even on the HUD. It's built into the cost of the deal.
Okay.
Right? I mean, you can do both, but it's built. Yeah. You build it into the cost of the deal to the investors, right? It's built right into it. So it's called in your closing cost. But that's your acquisition fee. Then you're getting paid an asset management fee monthly to manage it. I call it managing the managers, right? You hire the property manager, so you're not dealing with toilets and tenants every day. And then you're the asset manager. You're basically making sure they're doing their damn job.
Sure.
And you get paid a 1 to 2% per month fee on revenue to make sure they're doing their job, right?
Yep.
That's that one.
And they're charging you probably what, 6 to 10%?
6 to 8 on a property of like a 20 to 50 unit. Yep.
Yeah.
We're in there.
Yep.
So you're adding another on top.
You're underwriting like 10% total property.
At the end of the day, fee. I mean, the asset management fee is paid at not to get complicated for people, at the entity level, not on the property level. Yeah. But, yes, all of that. And then you're getting paid, typically if you're doing some renovation on the property, you're getting paid a construction management fee, 8% of the hard cost monthly. Mm-hmm. Mm-hmm. And then you can also get paid these other things called a refinance fee. So let's say year 3, right? You refinance that property, the process of you going through and putting all that together, you can get paid 1% on the loan amount that's coming out. So if it's $1 million loan amount, right, you're getting, what is that, $10,000, right, or more?
Yeah.
Yeah. And then there's also what's called a disposition fee, which means when you go to sell that property, you as the syndicator putting all that together to get it sold at a maximum dollar can get paid 0.5% to 1% on the exit price.
Yeah.
It's not a commission. It's not a broker fee. It's a disposition fee for you as the syndicator. There's a couple other fees that I'm missing in here.
I mean, that's a lot in itself.
Yeah, some of them are monthly, but it's 5 to 8 different ways.
Yeah.
When you actually look at the money, you're like, how do I explain this? You either bring the check equity or the sweat equity to these deals. Mm-hmm. You decide. Mm-hmm. So everybody's like, oh my gosh, it seems like, I'm like, yes, you have to realize if you have this skill set to do this, you are basically a neurosurgeon for apartments. Like your skill set level is at a level for investors that is like a neurosurgeon is to somebody that needs a brain surgery.
Exactly.
It is extremely valuable. It's no different than a hedge fund manager. Why do hedge fund managers make so much damn money? Because they have a skill set to be able to take everybody else's money and go make more money with it. Mm-hmm. You as an apartment syndicator sponsor, you have the skill set to go take investors' money and go make a bunch of money with it for them and you 100%. And everybody. That is extremely valuable, right? And be able to work through this process of real estate. And so once people, like the link goes off, they're like, okay, so I just need to get skilled. And I'm like, yeah. Mm-hmm. I said, with all due respect, I got 2 master's degrees, an undergraduate degree, and all these other great degrees. And they're great. They're good for the wall.
Sure.
But my knowledge in syndication is worth 10x those. And I paid a quarter of what I did for learning that info than I did for going to college for however many years, right? So it's putting it in perspective of the skill set you get to learn. And it's stupid how valuable it is when you can execute it.
Yeah, I think one of the biggest hurdles, at least for myself and probably for others, a lot of the listeners, is you really have to be comfortable going out of state. Like you were in California when you started, and prices are just too damn high there. And kind of similar here, we're based in Connecticut.
Yep.
So we have 60 units or so, have 100% equity, but to really get to that next level, you have to branch out, and you have to be comfortable branching out.
Yep.
But it's no different. Like, I have multifamily here that I have third-party property management on. I haven't seen and I'm 30 minutes away. I haven't seen those buildings in a year or two. It's no different than finding a reliable.
That's exactly right. So and there's a couple of ways to get around that, because I was in fear of that as well when I was in California, flying halfway across the country into the Midwest. How do I manage these things? And what if something happens, right? All these things that go through your mind. So yes, having good property management, knowing how to hire them locally, number one. Number two, we put cameras on all of our buildings. So I can pull it up on my phone just to get peace of mind, just to look at it, make sure it's not burnt down today, right? On all the buildings. So that's number two. In the beginning, when you buy these things at first, so you'll probably be out there once a month for the first probably 2 quarters. And then it'll fall back to where, like you said, once a year. I mean, there's some properties I haven't been to in a year and a half. Yeah. But if they're operating correctly, then you don't need to, right? Meaning, once again, this is just something you learn, but there are 4 reports, that you will review as an asset manager every single week. And these 4 reports will tell you everything that you need to know as an owner, operator, as to how well it's doing or not doing. That's it. And if those things are in alignment, then maybe you have a 30-minute phone call with the property manager each week, and things are running. If those things are not in alignment, the reports will show you, and the financials will show you. And then you can dive in a little deeper, right?
No, that's good.
But the whole goal of this is to build and scale to where you're not dealing with the toilets and tenants every single day.
Yep, 100%.
Because you probably have another job, a career, something you're building. And so this is another thing that you're building, right? Call it your side hustle in a way for your family's wealth, your financial freedom, your legacy. And it'll get to a point where it's cooking enough, right? I mean, if you're generating an extra 10 to 20,000 a month, mostly passive, from these apartments, and it only takes you 3 to 4 30-unit complexes to make that on average. Because about $200 on average, around $200 per month per unit, free cash flow for you as the sponsor syndicator. On average, give or take.
So how many units are, at what point you think you're going to hang it up? Have you got 1,200 units? 10,000 units.
And $1 billion. Yeah. $1 billion in assets and 10,000. And we're behind the curve, man. I have friends in the space that are 4,000 or 5,000 units. And I'm like, damn. So, they were able to capitalize right before the markets shifted quite a bit here recently in the last couple of years. And they were able to acquire up. So they're a little ahead of the curve. And then they have a couple extra capital partners behind them right now that's allowing them to acquire some distressed stuff that's out there. So that's been nice because they have some big check writers. So it's just having connections. It's just people and connections.
Yep.
But yeah, that is the dream for that, to get to that point. And then, I don't know if you'll ever have 10,000 in your portfolio all at one time, but being able to go through and work through 10,000 units, $1 billion in assets and transactions and all that stuff would be pretty powerful.
It's a pretty cool day.
Yeah, it's a pretty cool day, and then be able to, put time into other things that are more of a passion for you, other than just apartments and making money, right? Because we're making the money so we can actually spend time with family, do the things that we love most, and get back to passion projects and help others and all the things that are bigger purposes in life, other than just cranking out the dough. But the dough gets you there, right? It gives you the resources.
Sure. It's so funny, like I said, number 53 right now, and I've probably 42 of the episodes have been syndicators, but no one, and no fault to anyone else, but no one that's really put it in the way you did it. Because I've always been like, oh, I got to have 100%. I got to have 100%. Like, why? You're just buying these to sell it, but it's an active job. You're replacing one job with another, but you're getting 30-40% of something much bigger than you, and you could eat. It's just
once you
like the light bulb went off.
The game of money, it answers all your questions. I mean, and this will answer for you real quick. The 5 richest people in the world, and this is, you could 10x this, right? Elon Musk. How much of Tesla does he own?
It's all stocks. It's all the shareholders.
He owns less than 10% of Tesla.
Yeah.
Richest guy in the world.
Yeah.
Right? You're going to own 30% of an apartment complex. He owns less than 10% of Tesla. He understands the game of OPM. Jeff Bezos, Amazon. Less than 15% of Amazon. 3rd richest guy in the world, or whatever it is, right? Yeah. He understands the game of OPM, meaning he can put some of his money and bring it in, right? It went private and then public and all the other things they've done, but they're using other people's money. They're just doing it with businesses. You're going to do it with apartment complexes. Same concept, right? Exact same concept. You're just doing it with real estate versus companies. But that's it. I mean, you could go public if you want to build a big REIT, right? Apartment REIT, and you could go public if you want to. I don't, it's not my cup of tea, but I want to stay private. But you're doing private offerings. I mean, you're raising capital privately. You're basically doing exactly what Elon Musk is doing. You're just doing it for apartment complexes. And so it's understanding, when you realize that it's not in keeping it to yourself. I used to think that too.
Yeah.
Once I understood that, oh, dude, if I can acquire a really valuable skill set to go find great deals, put them together, structure them, raise money, and put them all together for me and other people. Everybody wants to invest in real estate. Have you ever met anybody that says real estate investing sucks?
No. I haven't.
So like, the real estate is not the problem. It's just making sure you have a good deal, number one, and that the person you're investing with, you trust, you like them, 100%. Right? That if I give you 25 grand, 50 grand, 100 grand to go invest along with you, we're not going to be on an American Greed show in 2 years. Right. I mean, that's really what it comes down to. That I like you and I trust you as a human, and
sure,
I'm going to get my money back, hopefully. Right.
It's the goal. Yeah.
Yeah. I mean,
how do you spend your days now? What's your from the time you wake up to the time you go to bed? What's your day look like?
Yeah. So I'm first thing in the morning, I'm always pulling up, looking at the financials on a couple of the deals, those 4 reports on our deals. Yeah. Number one. Number 2 is, we have a community now that we've started where people are learning exactly this. So I've with our teams and stuff, helping manage that throughout the morning. And then honestly, what's great is by the afternoons, the days free up a little nicer. And I get a lot of time with the kids, man. I love being able to like literally, if I want to sit on the couch and have a coffee, I can do it. If I want to go to their soccer games, and I don't have a problem being able to go to their stuff if I can, and just not being forced to go sit in a office and report to somebody else and make somebody else wealthy when I know I have the ability and skill sets to do this for myself. But you gotta invest in yourself, believe in yourself. I mean, I don't know what your biggest fear is, Michael, but and I don't know what other people are listening, but honest to goodness, my biggest pain or fear is being 80 years old, sitting on my deathbed in the hospital, having to have a conversation with my 40-year-old self, which is what I'm at now, and having to tell that 40-year-old person, dude, I'm sorry. I'm sorry I didn't go for it, man. I'm the future you, and I was too chicken, you know what, to go for it.
Mm-hmm.
And so I played small ball. I played it safe, because I thought I had all these responsibilities and I had to do this and I had to do that. And if I took risks, then I was putting my family at risk, or whatever it is, right? All these things come up with our
million
brain
excuses.
But you know what? You got to go for it, man. If you want it, you got to go get it. And nobody's gonna, come in and do it for you. I got news 100%. For you.
Well, congratulations. Yeah, no, you took the leap and you guys are killing it. So congratulations on all your success so far. I hope the listeners, took a lot away from this episode. I know I did.
Michael, now you're going to go do it.
I know. It's like,
it's starts with one, right? Just keep it bite-sizable, right?
Yeah.
10 to 30 unit property for your first, call it syndication. And the reason why this happens is you want the capital raise to be reasonable. You want the loan size to be reasonable. You want to deal with more mom and pop type, either brokers and sellers and lenders and all these people, because you're newer or newbie. Sure. So you need to play in that newbie space for your first couple deals. And then you'll get the confidence underneath you once you close. And then you're like, okay, I got it. Now I see this 50 unit over here. Maybe I can go for that. 10 to 30 units is the sweet spot to start. Yeah.
100%. So one thing my business partner and I are kicking ourselves in the butt about is we ended up selling a 5 and a 6 unit in our local hometown that we love these buildings. We bought them. We added value, bought one on seller finance deals, added a ton of value, did a cash out, made the numbers work. It was like the perfect deal on paper, right? Loved it. But we found an opportunity to go buy a 40,000 square foot mixed use property in a different market. And we said, okay, if we sell these two assets that we could pull out a lot of equity, we could do a 1031 exchange and go buy this other property, then that's what we'll do, because the only way we could afford it is if we take the equity from this.
Right.
Had we just said, okay, we're going to keep these, we'll still put a little bit of money in this 40,000 square foot building and we'll raise the rest. We would have now still had way more, we would have still acquired that 40,000. Maybe we have a little bit less equity, but you can still have all the tax benefits, which is really like half the reason why you buy these things.
Yep.
And still have the 5 and 6 unit.
That's right.
But again, it's like you're thinking, you just need to shift your mindset, and it's okay to you don't have to be best friends with these LPs that are investing with your deal. You just want to take care of their money and make sure the deal makes sense. And you as the GP are still calling the shots at the end of the day. And that's like, again, you're not reporting to a boss. You are the boss. Correct. That's the mindset. It just takes a little bit.
You're accumulating an extremely valuable skill set to do that.
Yeah.
Right? That's what I keep telling people. I said, sweat equity or check equity. You choose which one you got. Yeah. And listen, if you have a fat bank account that's got gazillion millions in it, sweet. You're the check equity writer. Awesome. Yeah. Maybe you don't need OPM, but good for you. Right. Mm-hmm. Most people can't go stroke $3 million checks.
Right.
Right. Most people, maybe you can strike a $50,000 check or a $100,000 check or something right around there. But we started with $25,000 down on a condo and then scaled it to where we're at today. I mean, you don't do that alone, number one, and you don't do it by playing small ball, trying to do the only my money game. We did that for 8 years. I mean, if you put perspective of scalability, it took us 8 years to get to 20 units. It took us 3 years to get to 1,200.
That's crazy. That's a crazy stat.
Yeah, it's just, and when you realize it's just, you gotta be good at finding good deals, and there's a process for that too. There's an absolute process.
What are you doing? Direct mail postcards? You have brokers calling for you?
No, there's direct to broker and direct to owner, right? Direct to broker and direct to owner. There's 2 ways to find deals. So anybody who's newer in it, you need to build the broker database, right? Because anything on Crexi or LoopNet, you're only seeing about 20% of the marketplace. Those are the leftovers. Anything on those websites, you're seeing leftovers. Those are not the deals. Those are the deals that everybody else passed on. And so they stuck them on the websites.
Sure.
Right. Which is why they don't make a lot of sense. And, they have to be highly negotiated. So the pre-market deals are the ones you want. You do not get access to those until you build a little bit of rapport with the brokers.
Yep.
Yeah. And so you can use their online listings on Crexi and LoopNet to get to meet them, talk to them. I do it all the time. I mean, because we have our Tuesday, Thursday calls with our community, and I'll live call brokers because they're all scared. Like, what do I say? And I said, we do it all. We record it all. And I'll live call them. I'll show you exactly what you say. And once they see that, they're like, oh, it's not so scary. I'm like, yeah, they're people. They're people. I'm just using their listing to figure out more info. And then I get to meet them. And then we build rapport. And then I get to see pre-market deals that are getting put out there before they hit the websites. And those are the ones that make sense because then you can get deal flow. Yeah, so that's 100%. Way number one. And I would recommend that first for anybody because if you go to direct to owner approach, like we have a software we developed for that, but that's highly capital intensive. So until you get your first couple deals under your belt using the direct to broker approach, then you can go to,
doesn't cost you a thing.
Yeah, then you can go to direct to owner and postcards and mailers and calls and softwares and all that other stuff to do that, but it's not efficient use of your time in the beginning. Yeah.
Okay. All right. Well, Justin, thank you so much for everything. I learned a lot. I'm sure the listeners have too. If people want to learn more about you or find more about you, where can they go?
I send everybody to YouTube. We're pushing our YouTube channel, a bunch of free content you can enjoy. Yep. So you go to Justin Brennan Multifamily on YouTube, Justin Brennan Multifamily on YouTube, and suck it up and enjoy it. And if you like more, you can come in further from there. So
awesome. Well, thank you again for your time. We'll be sure to connect afterwards. And thank you to all of our listeners. Another episode of here at Sky's the Limit Podcast. And we'll talk soon. Thanks again.
You bet. Thanks, Michael. Thanks, everybody.
Thank you for watching Sky's the Limit. We're always releasing new real estate content. So if there's something you want to hear, be sure to leave a comment. And don't forget to subscribe to our channel.